today's video, I'm going to talk about the market maker trading method, which reflects one of the ways that market makers or large traders can use the charts to enter the market in specific points. Unlike popular belief, this type of market maker cannot actually see the trading orders in the different price levels, but due to the predictable way in which some retail traders act, the large traders know where large clusters of orders will be. The bottom line is that most retail traders act in the same predictable way repeatedly, meaning that they place orders in the same points in the chart. For example, breakout traders, which are one of the most common type of retail traders, will always put their orders on highs and lows in the attempt to catch some sort of market movement when price surpasses a high or a low. This is a bad strategy for many different reasons. It creates a poor trade location, which is something that twists the risk management framework, and it's also extremely predictable to the other market participants. In summary, the market makers can indeed take advantage of this predictability in the way retail traders act. I want to show you an example of that in the Euro-USD 1 hour chart, but remember that this can happen in all markets and in all time frames, so the same analysis applies. Here in this chart, we can see the aftermath of a market manipulation that happened in the candlestick with the long upper tail. Notice that a few candles before that, the retail traders in this market were probably thinking it was a good idea to go long at the breakout of the last market high. What happens is that hundreds of thousands of breakout traders think in the exact same way. That leads to the formation of a cluster of buy stop orders at the level of that last high. Here we have to go back to the fundamentals of any market, which is the simple mechanism of supply and demand. A deep cluster of buy stop orders means that there is a lot of demand in that particular price level. If there is a lot of demand, there is the possibility of a large supply as well. Here's the sneaky detail about large traders. The fact that there is a deep liquidity pool in that level means that they can get in the market with large positions without distorting price too much because of that large demand. In normal conditions, where the liquidity would be shallower, the market makers will have to dry out the liquidity of many price levels to get the same position in the market. In that sense, the predictability in the behavior of breakout retail traders ends up helping the market makers to get in the market with very large positions that wouldn't go unnoticed in normal situations. The large upper tail of that candlestick reflects this paradigm exactly. As soon as price hits the deep cluster of orders in that high, market makers engage the short entry. The thing is that the short position size of market makers must surpass the size of all long positions of breakout retail traders. The long upper tail in that candlestick shows that this was in fact the case. In other words, market makers use the deep liquidity pool formed by breakout retail traders to enter in the opposite position. And now the retail traders are hopeless about their long trade idea because as soon as price hit their entry trigger, it starts going in the opposite direction. Many of these retail traders end up getting desperate and reversing their positions, which only helps the short position of market makers even more. From this point on, we can start building the line work that can potentially lead to a short trade entry because we want to be on the same side as market makers, obviously. The market manipulation mechanics form the context for the trade, meaning that we already know that we want to go short, but we need to get the timing correctly. The most obvious thing we can do here is to draw a simple Andrews pitchfork using the more relevant market extremes in the chart. That will form a downsloping pitchfork that can shed light onto the current market edges. When it comes to line work, we never want to trust one line in isolation, meaning that we want to find intersections of different lines, and all of that must agree with the overall context of the market. Another line we can draw here is a more refined type of line that catches the frequency in a cluster of upper tails and forms a specific angle. Notice that we can already see that such line cuts through the long upper tail of the candlestick where the market manipulation occurred. We can draw yet a third line, which is a horizontal frequency line that catches the two minor highs, including the one where the manipulation maneuver occurred. Notice that the upper line of the Andrews pitchfork, the downsloping frequency line grounded on the abstract point, and the horizontal frequency line are all correlating in one small area of the chart. For all intents and purposes, this means that if price is going to reverse and give a short trade opportunity, that intersection zone is where it will happen. When price reaches that area, we can look for further confirmation in the form of fractal bars, hybrid bars, and things of the sort. Speaking in terms of risk management, that entry zone is near a logical place to put a stop loss order, which is above the long upper tail of the candlestick where the market manipulation maneuver happened. It makes logical sense to put a stop loss above that level, because if we are indeed talking about market makers, it's unlikely that they are going to let price rise to that level again anytime soon. For the target, we need to look for an area that will allow this trade to have around 1 to 3 risk-reward ratio. The lower line of the Angel's pitchfork can act as a dynamic target that meets that criteria. So the longer it takes for the trade to close, the higher the reward, and therefore, the higher the risk-reward ratio as well. So let's see how price develops. Here we can see that price enters the small zone created by the 3 intersecting lines and then proceeds directly to the lower line of the pitchfork. Notice that when it touches the lower line of the pitchfork, it creates a fractal bar, which is something that would add even more to the reliability of the target in question. If you want to learn how to trade using these techniques, check out the Market Maker Strategy video course in the video description. In this course, you'll learn in detail many techniques that will allow you to trade with the market makers, instead of trading against them like most retail traders do. If you enjoyed the videos I produce and wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video with your trading community, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you for watching, and I hope to see you in the next videos. Take care.